What we're trying to do is you're taking your W-2 income and you're taking your short-term rental, making it non-passive, because this is non-passive, and offsetting each other with the cost segregation, which you saw how it works in the numbers.
Hey everybody, and welcome to our second live session of the year tonight. I have questions for Assis. This is our monthly Q&A exclusive to our amazing community of clients who are proactive, curious, and committed to building wealth the smart way. Let me go ahead and share my screen before I forget. Okay. You brought the questions tonight, and we're bringing you the strategic answers. We will get into those in just a second. This month, we're also excited to welcome a special guest and IFC client, Bhagyashri. We will introduce her to you guys in just a second, but just a reminder, if more questions come to your mind during the session, drop them in the chat and we'll cover as many as we can at the end. So let's get started. Now, I'm sure most of you have met our speaker for tonight, but if you haven't, I'd love to introduce Assis Acharya. Assis is our CEO and founder and lead CPA here at Investor Friendly CPA. He is the brain behind our entire ecosystem, including our outsourcing firm, full-time employee, and our charitable arm, the IFC Hope Foundation, and our tax planning software, TaxMD, that we will be launching very soon. Assis doesn't just talk tax strategy, he lives it as a real estate investor and business owner himself. He knows exactly what it takes to save money, stay compliant, and make smarter financial moves. He and our team of CPAs are here to help clients like you do the same. Today, he's here to break it all down and answer your questions live. I also wanted to introduce our guest speaker for tonight, Bhagyashri. She is a W-2 software engineer who actively invests in real estate while building a fast-growing community on social media. She shares her real-world experience balancing a demanding career, investing, and content creation, helping others see what's possible when you're earning W-2 income and thinking like an investor. She also has a community of her own called Smart Her Finance. This is a women-only community. Sorry, guys, but it's for growing wealth and improving financial literacy. QR codes for both of her pages where she shares her insights are on the screen. Feel free to scan them, and we'll be sending her information to you via email after this session has ended. Tonight, you'll hear how she approaches wealth building as a high-earning employee, the questions she's had to ask along the way, and how community strategy and education play a role in doing it sustainably, all while getting your own questions answered by Assis. Now, we've mentioned this before, but if you're one of our clients who has started receiving these guides, these resources are part of our generational wealth formula, which are also on our website for just under $2,000. That means you're already receiving this added value for free. Since we have entered this new year, you probably have new ideas and new goals, and now is the perfect time to take full advantage of these guides. If you have any questions or want to upgrade from tax prep to proactive tax planning to maximize your time with your CPAs, just let us know. We're here to partner with you and help you along your wealth building journey. We're also developing a lot of videos that deep dive into these guides. So make sure you're following us on social media, on YouTube specifically. The links are included in the guides, but we wanted to highlight that if there's a topic you're interested in, a guide and video are probably coming, or you can always ask your CPA if we already have a resource available. If there are any videos that resonate with you, please share those so that we know what content you want to see more of. We'll be sharing some of our newest guides with you at the end of the call, so definitely stay on for that. Tax planning is a long-term game, which we will see tonight as we have questions come in and learn about Bhagyashri's journey and hundreds of strategies that are out there and that are in these guides that we send. You probably wouldn't use all of them in 1 year, but maybe you could in years to come, which is exactly why we've developed this software that we mentioned earlier, which will give the opportunity to everyone to access these tax strategies that we're talking about tonight and apply it to your own personal financial situations with the help of AI. This essentially makes tax planning more accessible and affordable, which is really exciting. We will give you the opportunity at the end to join the waitlist for this and get a sneak peek. Another announcement before we get started is that we are now offering bookkeeping. So if this year you want to get on the right track with getting organized, keeping up with receipts, expenses, and reports has been pulling you away from your business or is taking time from your planning process with your CPA, that should be used for growth and strategizing, not organizing. You should consider adding this to your plan because keeping up with these things shouldn't be a burden. It should be a tool, and you will have the opportunity to add these to your plan. We'll be sharing a QR code at the end too, where you can schedule a free consultation. All right, now that we have those housekeeping things out of the way, let's dive into one question that we get a lot, and that's related to our special guest speaker tonight. I make over $300,000 on my W-2 and pay around thousands in taxes every year. I've heard real estate can help lower my tax bill, but I'm not exactly sure how. I already own rental property, but it doesn't seem to be helping much. What am I missing? It is a great question, and this is where most high W-2 income earners get confused, and some don't even have a rental property yet. So this person is on the right track, but this is where a lot of people and even investors themselves get confused. Assis, feel free to chime in if you want, but the first thing that you have to understand is passive versus non-passive income. The IRS separates income into two categories, passive versus non-passive. Rental real estate is generally considered passive. Your W-2 wages are non-passive, business income, non-passive. So the key is to understand those two, and then the rest of the strategies start to make sense. So do you want to jump in, Assis, and talk about long-term versus short-term, and then we'll get into...
Sure. So let's get this question out of the way so we can really talk to Bhagyashri about her journey and everything. We'll dive deep into this question and the actual numbers in the next few minutes. If we strictly talk about real estate here, short-term and long-term have exact same tax benefit if you are a real estate professional, meaning where short-term rental comes in is different is when you have a W-2 job. Let's say you cannot qualify as a real estate professional, then short-term rental can help you when long-term rental cannot help you save taxes. In the long run, you want both of them in your portfolio so they talk to each other, either with or without rep status, which is basically real estate professional status. If you do not know what real estate professional status is, real estate professional status is not about being a real estate agent. Or even if you flip a house, you cannot be a real estate professional status if you don't meet certain hours and other requirements, which we can talk briefly in the next few minutes. Long-term and short-term has the exact same tax benefit if you qualify as a real estate professional. If you cannot qualify as that rep status, then short-term rental can really help you save taxes when long-term rental cannot help you save taxes. That's what we're going to talk about today, and how you structure it and how the cost segregation and depreciation plays for both of them, how the entity structuring LLCs and S corporations into play with this strategy is what we're going to touch upon in the next few minutes as we dive into questions and our journeys together here. But the question is very good. We will walk you through actual numbers and detail and how to structure it in the next few minutes. So let's get started with Bhagyashri and welcome her and see what's going on.
So, Bhagyashri, we got an inside look at your journey before this call actually started, but I think that you mentioned that you started with long-term rentals. What made you want to take the leap into real estate investing, and walk us through that, and then how you got started, what you got started in, and then we'll talk about where you're going.
I'm a W-2 earner. I work at Microsoft as a software engineer. Even my husband, he is a software engineer. He also works in tech. So we both were earning a lot at one point, and a lot of our money was going to taxes. And we thought we need to do something about it. So that was the first point of thinking of getting into real estate. And we wanted to create asset that is cash flowing, that appreciates, and first thing provides us tax advantage. And that's when we started looking into real estate. And how my journey started into real estate is I come from a tech background. I don't have any real estate background. In 2021, we bought our primary home. And that's when I started understanding the real estate properly. how to understand properties on Redfin and Zillow, how to talk to realtors and understand the stuff. And once we got comfortable with it, our first investment property was actually a long-term rental. It is a triplex. So two of them are long-term rentals and one is midterm rental. But to let you know, we started just because we wanted the tax benefits. We wanted cash flowing asset, and we got all the learnings from YouTube's Bigger Pocket podcasts. And yes, that's how I started.
So from there, you mentioned earlier with us that you then decided to jump into short term because the tax benefits were a little bit more beneficial to you. So when you were just doing the long term and the midterm, what strategies, and Assis can touch on this too, what kind of strategies were you using then? And then if you could compare that to now doing short term.
So when I was only doing long-term rental, we were just doing standard deductions like home office allocation, because I also have one bedroom in my house, which I use as my office real estate investment. So we could benefit from that home office allocation, and some vehicle expenses related to property management we could deduct, and standard mortgage interest deduction. So all those were like standard things, and it was helping us to get started. But considering our W-2 income, we wanted something which will help us save more money. And that's when we started looking into short-term rentals. And my short-term rentals, I manage them personally myself. Since I'm actively managing it, I'm spending more than 100 hours annually. It counts as material participation. And that's how we can use the STR loophole. In STR loophole, what we are doing is we hired a professional team which did cost segregation for our property, and we did the bonus depreciation for that property. Basically, in long-term rental, most of the losses are passive, which can only be deducted from the passive income. But in STR, since I'm actively managing it, these deductions can be reduced from our W-2 income. So that's the major benefit we saw moving from long-term rental to short-term rental. And that's what we are doing right now. Like Ashish can talk more about it, like how we are doing bonus depreciation and cost seg.
That's great. And yeah, that's what we just talked about answering that question, is the difference between passive versus non-passive income. So the long-term rentals that you were using before were considered passive. And because both of you guys have the W-2 jobs, you're not really able to do the rep status. So that's why it's
Yes.
considered a loophole, the short-term rental loophole, and why you got into short-term rentals. So I think that's great that you were able to try both and see the tax benefits with both, because I feel like a lot of people either jump into one or the other and they don't really see the comparison. But that's also amazing that you are able to manage all of the rentals on your own. I feel like a lot of people get overwhelmed and it's a lot of work, but maybe at the end or even in another webinar, you can touch on how you're able to do all that. I think I saw a post that you use AI to help you. Assis, I don't know if you wanted to jump into some of those numbers now, and then we'll talk about where she's going to go this year and in the future with some of her investments.
Thank you for sharing that. What you did is what mostly when people get started, unless they already know about short-term rental, obviously people would house hack and get a multi-family and multiple units for better cash flow and slowly dip into real estate like that, which you exactly did. Sometimes it's a better option because you know how you're managing your own properties. Some people will directly jump into short-term rental without zero systems and they get overwhelmed and they think the market is not good. They can make money and move on. So what you did is actually a better way and sustainable way so you can increase this. I can tell you if you have a system in place, you're only gonna buy more properties, make it more profitable, get rid of non-performing asset as you move on and have a best of the best assets in your portfolio, which I want to talk about. People do say, like for Bhagyashri, the long-term rentals were not really saving your taxes. I'll tell you why. In general, as you move into more into your portfolio, even like someone like Bhagyashri who cannot really benefit from long-term rental should look into long-term rentals I'll tell you why, especially where the market is going, because market is slowing down. You can see you're going to get better assets. When you do that, don't just chase a short-term rental, because there will be some opportunity in long-term rental as well. And I'll tell you how to manage that in the next 2 minutes. But before I do that though, I don't want everyone to be on the same page about what we're talking about real estate and why this is so important. And then we'll go into some of the rules and structuring it. Bhagyashri said, use this lot of these strategies on her own, this vehicles and then home office. Those are very basic strategies. And you can Google it and they will tell you. But some of the things we're talking about right now is a little more complicated. And when it's complicated, you need to have professional help or an experienced someone like a Bhagyashri to walk you through that. I want you to focus on my screen. It looks daunting, I know, but all you need to understand is this, okay? I'm going to show you this. This is one of the Excel that we created a long time ago. This is the tax planning what we have. This is what we're converting into our software right now, but you can ignore all the numbers. Just focus on this. Let's say this was actually one of the client or one of the taxpayer who lived in Washington and makes let's say $650,000 W-2. Everything else, as simple as that. The source of income doesn't really matter. It could be multiple W-2, it could be capital gain by selling the property, or it could be your business, your husband is a realtor. It doesn't really matter. Just focus on this number around $650,000. What's happening right now is what Bhagyashri is doing and how everyone should be thinking is this. I'm going to do real estate planning where I can show you guys like how you should be thinking here. So this $650,000, you're paying around $157,000 taxes. Okay, let me walk you through that. So do you see this? It says $623,000 of your taxable income. You're paying that much tax because you live in Washington. There's no state tax. So just trying to make it easy. And there's some other Medicare tax. Ignore that. But actual income tax that you can offset is $157,000. If I were to go and then walk you through how can you manage this tax, what Bhagyashri is doing is pretty simple. Just focus on the number here. How big of the property, let's say short-term or long-term, depending on your real estate professional status, should you be buying to offset this tax? If you see here, with 100% bonus depreciation, and then with cost segregation, that's a 3 million. So if you were to go, or someone this tax were to go and buy this property, he or she is paying zero taxes. I mean, there's no tax, it's gone. You completely offset your income, taxable income. If there's no income, there's no taxes, obviously. So this $157,000 they actually paid to the government. If you already paid through your W-2, it comes back to you as a refund. It's not even taxable, it's a refund. So you get entire $157,000 in your pocket back. Everyone needs to know their upper threshold every single year so you can manage your investment. But even let's say someone who just started and wanted to buy, let's say $700,000 in a cabin in the mountains, even that saves you 50 grand in taxes. 50 grand is a huge amount of money, tax-free money. They already paid to the government, comes back to you. So this is how you manage and understand your upper threshold and how big of the property you are buying. That's one thing. How to release this to actually save these taxes is what we're going to talk about next, but you need to understand how the numbers work. What you're trying to do is basically buy an asset, deduct the cost segregations against your income, and save taxes. The basic concept. How big of the property depends on your portfolio. That's what I was walking through the numbers. One big thing before I jump and start sharing this and how to meet the rules and how you should be doing and how Bhagyashri did it, I wanted to show you one thing. And this is where the Bhagyashri, I know we can talk about renovation. I just want to show you one thing here. Now, what kind of assets should you be buying to get the most out of it? This is how you evaluate. Let's say you bought $1.5 million property. That saves you $94,000 taxes. That's a big property, right? Great. Everyone's happy. However, I've done this personally and a more efficient way of really getting most equity in the property and then get a better property, like a newer asset, so there's no repair and maintenance, and actually get better tax savings is, let's say you were to less investment on front end is this. Look at this number. 1.5 million is saving you $94,000 on taxes. However, if you were to go and buy, let's say, $600,000 property, it drops down the tax savings to 42. But let's say you go and renovate $250,000 on the renovation, that actually saves you more from $94,000 to $110,000, almost $111,000. But your actual investment is only your purchase price is $850 versus 1.5. It's like almost half. So you get better tax savings by half of the investment, half the down payment and everything. So if you look at this property, when you buy a distressed asset, and you're going to find more of them now if the market turns. And remember, what everything we're saying right now, this is February. You can do this in December, November. It's still same tax benefits. So you have entire year to find a good market and talk to Bhagyashri to figure out marketing strategies, and talk to us to figure out how to manage the tax savings. You have time, but understand that having a right kind of asset also saves you taxes differently as you move forward. Okay. Just to recap, I just showed you how the numbers work. I'm going to unshare my screen and talk about how to actually meet this requirement to actually have this. Just buying a property will not do anything. Just buying and renovating will not do anything. You have to actually meet some requirements. That's what we're going to talk about next. But I'll stop right now, Kensley, and then I want to ask back a few more things. Like you were saying, you manage your own property, having a full-time job. Tell me how much, I know you need to have certain hours for tax benefit, but is it manageable for you to manage your own properties? And does your spouse help you manage these properties? How do you guys do that?
To manage the property, I have lots of systems in place. I have lots of automations in place. I use PMS softwares, which links my multiple platforms in one place where I can manage multiple properties at one place. So basically, having systems in place, the automations is the key. And I use dynamic pricing softwares where I don't have to go and change the price according to festivals or holidays. It takes care of it. The only part I have to take care of is the inventory, or talking to my cleaners, talking to my handyman. These are things I'm personally handling. And guest communication. Sometimes, like, I have auto guest communication set up as well, but sometimes when the issue is new, that time I have to take a look into that message and reply back. But that's what I will say. Once you have the automations in place, the time required is much less.
Okay. And what about your spouse? Is he involved in managing any aspect of this operation?
He is only involved in finding properties, analyzing deals with me, but day-to-day operations, I am doing it through these softwares.
Okay, that's a very good way to set it up. And the reason is this. So just to go back to, she has a W-2 job, her husband has a W-2 job. It would not be possible for them to qualify as real estate professionals. Even Bhagyashri can spend half of her time managing her long-term rentals, still not qualify as a professional. And spouse, the same thing. Because the requirement for a real estate professional is you have to work as much and an hour more in your real estate management, and it could be rental real estate, flipping, wholesaling. So Bhagyashri needs to have another full-time job in real estate to qualify as a real estate professional, which is almost impossible when you work in a company like tech company with such demanding schedule. Very few people can have a full-time job, W-2, and then qualify as a real estate professional. Very few. I'm talking about 0.01%, because every court case is lost when this happens. That's why you saw the numbers we just walked you through. What happens is, when you have a short-term rental, it's not a rental anymore. From IRS perspective, it's a business, meaning it's a restaurant. Any kind of businesses which is non-rental, for it to be non-passive, you have to meet material participation. There's a 7 test. What Bhagyashri is doing is this 100-hour test, but there's also all the other ways to do, which I'll talk about next. But I want you guys to understand the concept. What we're trying to do is, you're taking your W-2 income and you're taking your short-term rental, making it non-passive, because this is non-passive, and offsetting each other with the cost segregation, which you saw how it works in the numbers. Can you do the same thing with long-term rental? Yes. But what I was saying earlier in the webinar was, for you to do the same thing with long-term rental, you have to qualify as that real estate professional, which most people don't. That's what we're talking about, short-term rental. So short-term rental and long-term rental in this bucket, and your W-2 income, your business income in this bucket. What we're trying to do is offset each other with real estate. Can you do it long-term versus short-term? Depends on the status of what I was talking about. So we're going to ignore long-term rentals right now. We're going to focus on short-term rentals. What Bhagyashri is doing is qualifying under material participation, so they offset each other. So there's 7 tests. Bhagyashri is doing 100 hours and more than anyone else. Few things I want everyone to understand. 100 hours and more is one of the easiest tests to meet. But in the multiple court cases, if you do not track your cleaners hours, you could work 500 hours or 400 hours, they would still deny you the deduction, because you still have to reasonably track your cleaners hours, your handyman hours, because the rule is you work 100 hours and more than anyone else. There was a court case where the taxpayer worked 350 hours, There's no doubt he made that 100,000 more. What if you clean out work 300 hours, almost as a full-time property manager? They're going to tell you that. So make sure you could just email them and ask them and explain them why you're asking so they don't exaggerate their hours. Or you can do a quick in and out of your camera to see how many half an hour it takes them to clean up, and then you can do turnover to figure out how many hours they're spending. You have to have actual data. If you get audited, you don't have to present that to IRS when you file a tax return. If you get audited, you have to show that, and it's always very hard to go back. So every year, I recommend having a system in place. There's one more thing to track it better. You can never be audit proof, but it's defensible. You can defend yourself when you get audited, which we had before. So meeting material participation is good. I was talking about 100 hours and more. But there are 2 more hours that really works. If you have multiple properties, the 500 hours is one of the best hours. Meaning, if you work 500 hours, it doesn't really matter if you have a full-time property manager, manage the property on the ground, you still qualify as material participation. So someone like Bhagyashri, say exactly how to use this for your benefit. As you expand, let's say you have multiple properties. If you have 10 properties and you're out of state, you can literally outsource every single one of them to property manager and not even set a foot in them. And you have this one property you just bought, you're designing it, doing a lot of stuff, and you have a lot of involvement. You spend 500 hours on this one property. You can combine all the properties as one activity and meet 500 hours for all the properties, even though it's in other states. Same thing applies to 100 hours too. What I'm trying to tell you is combining asset into one activity, and there's some certain ways to do, and then meeting hours in one property, just extrapolates those hours to other properties as well. So you could buy one in-state, manage that by yourself. You can buy one out-state and completely outsource that and still be a materially participating on both the properties. Again, I know it gets complicated, but that's what you do. Work with your advisor to come up with the strategies and out-of-state and in-state. You can do 500 hours, you can do 100 hours, but one strategy that even Bhagyashri can do and anyone else can do is this substantially all participation test. Meaning, someone comes to me in December and says, hey, I want to buy a short-term rental. I heard about this and market is great. How can I benefit from this? Can I? And they always tell me, I cannot meet 100 hours this year and it's already December. It's not true because you don't need 100 hours if you buy a property in December. There's another test that's called the substantially all participation test hours. Let's say you buy a property, you find a property in December 1st. It takes you 20 days to close. You close on December 20th, right before the holidays. You travel, buy a few stuff, you put it in the market, and then you have one or two guests. It could be your friends and family who stay there. You have 2 rental and tenants in there by the end of the year to make it short-term rental, less than 7 days on average. And then there's no one else involved. There's no cleaning required. There's no one else. You manage everything. Then you have made the material participation. There's no threshold you need. You can work 3 hours, literally, to set everything up and have it up and running. So the Airbnb app, someone books it, your friends and family, they show up, they don't show up, we really don't care, they paid you. It's a loophole. That's what it's called, loophole. It might go away in the future. So you made a requirement by buying it, putting it into service, and meeting a material participation test, which is no hour requirement is December, because you made the substantial all participation test, which means that all the hours that was invested in this activity is your hours. When I say all is substantial, meaning it could be 90%. You could have 1% come clean up or fix something. You can still do that in December. So do not get discouraged when you found out this video in October and November and you thought you cannot do this. You can still do it, just so you know. So just to close this loop, what we discussed before is we showed you the numbers, we showed you how to meet the requirement and what Bhagyashri was doing and how she was managing it. And some of the rules can get complicated. I just was showing you that. Now I'm going to stop, and then we're going to talk about what really cost segregation is and how to structure your entities to make that work for you. But we'll stop right now and maybe answer one question. Bhagyashri, if you have any questions or concern, I want to hear that too. If you have any, let me know.
Yes, a lot of people ask me this question. So how many years minimum do you have to hold this STR if you are going to do cost seg and bonus depreciation on the property?
Perfect. That's a good question. And on top of that, what I get from our other clients is, hey, obviously everyone is trying to be smart, super smart about this. They want to buy a property, make it a short-term rental for the last 2 months, and next year either move in as a primary residence or convert to long-term rental because they cannot manage it. They ask that question. So it's the same thing. So let me explain this, how it works. There are 2 aspects what you just asked. One is how long this will be holding for the tax benefit to work. And the other thing is, can they convert them to other kind of assets? Those are the main questions we get. The first question you ask is, there's no requirement to hold this many years or to get benefit. As soon as you buy the property and you can meet the requirement this year, you get that listed at 150,000. Let's say you bought that $3 million property, which people do. Short-term rentals in the right areas are expensive. And if that $3 million property makes you $200,000 a year, that's when you meet a 1% rule already, which there's some properties who actually do that. And then you already bought that property, you hold that for next 1 year, 2 year, you benefit. However, if you sell it right away, there's a concept called depreciation recapture, which if you just sell it right away, then the benefit you just got, you have to recapture that. But if you hold it for the next few years, though, the recapture can be managed. Meaning, let's say you benefited $300,000 in taxes. If you hold it for 6, 7, 8 years and you then sell it, then the recapture can go down to 10%. Or even better, if you do 1031 exchange, the capital gain can be deferred. Remember, people gonna get confused about this. The 1031 exchange is a good way to defer your capital gain. But if you have done bonus depreciation, those recapture cannot be shielded with 1031 exchange. Only appreciation kind of gain and income can be shielded like an exchange, 1031 exchange. The recaptured income, which is in the tax as ordinary income, cannot be saved with 1031 exchange. So a lot of people think about this because that's what ChatGPT says, which is not right. Okay, if you buy a property and then I'm going to save this $300,000, I'm going to move into another property next year because I will save this money. It doesn't work that way. The cost segregation tax savings will have to be recaptured if you sell it right away. To answer your question, Bhagyashri, once you do the property cost segregation for the short-term rental to work, buy a good asset that you're proud of, you want to buy and hold it for the next few years to see the best benefit out of it. If you have to sell it for other reasons that you cannot control, then you can also buy another property to offset that gain. So you can always buy one property to get a tax savings and then sell it. You're going to have some recapture income, but buy another property and use that property to offset the recapture income. You can do that. You'll be in a zero position, but buying an asset is expensive. Realtor fees, lending fees, all those fees. You don't want to lose $20,000, $30,000 every time you buy a property. So once you buy a property, you want to hold it, is what we're talking about. That's what you're asking, Bhagyashri. Second question I get asked is, can I convert this to long-term rental or primary residence? And I'll tell you, there's a concept called in IRS books that says substance over form. Meaning, these all rules make sense, but if the IRS thinks the transaction was just as a form and the actual substance, there's no substance behind it, meaning this was tax savings, then they can deny the entire transaction. And this is one concept they use a lot when they have to audit people, when they see some sketchy thing happening like this one. So if you buy a short-term rental, will you wait to convert it to long-term rental? Answer is depends. How can you define? What is your narrative? Meaning you buy this short-term rental and then you shut down the short-term rental license. You start losing money and then you already tried everything you could possibly try, right? You can show them evidence of being in the market and not renting it out. And you make a business decision to switch, no problem. And you can wait 5 months and do that. But you have to explain that to the audit committee when they audit you, if they audit you. So that's a convert your short-term rental to long-term rental. If you want to convert to primary residence, same thing. What happens if your HOA comes with a new rule saying no short-term rental anymore? What are you going to do? I just bought this property. If I sell it, I'm going to lose money. I'm going to pay so many fees. You know what? I'm going to just move in. Either live nearby. I may have my other properties as long-term rental or short-term rental. I'm going to move into this property. So yeah, all I'm saying is, can you change the asset class from short-term to long-term or primary residence? Yes, the ISO is not stupid. So you have to document your narrative and then show them, even if it was intentional, never put that in email, never say that to your realtor, never say that to your CPA, say, this is my strategy. Don't say that. Intention matters. So have a very good intention, talk to your CPA, make an LLC, and have it a short-term rental. And then if you have to switch, you have to switch, but build that narrative, why you switched, and this is why you need to do it, okay? Does that answer your question, Bhagyashri? It's a long question.
Yeah,
okay.
Thank you.
Before we go and dive into how to start to do with the LLC stuff, I want to answer some questions we already have on the chat. So someone's asking, what is our view on buy, borrow, die strategy of building generous wealth? What is my view? That's what rich people do. What you're talking about is you buy, borrow, die. When you die, It goes to your heirs without any taxation, and then you keep on going. In this same question, people try to bring that 1031st exchange. That's the only thing I'm going to touch. People think I'm going to buy, borrow, and before dying, I can just keep on going in 1031st exchange to bigger and bigger properties. And then when you die, all the appreciation goes away. But don't forget that if you're going to use something like this strategy, then the 1031st exchange doesn't work. In normal long-term rental, yes, keep on moving up. There's never going to be recapture. And then when you die, it probably goes to your children or any area wherever you want to give it, and you can build your asset. But people get really upset when they learn depreciation recapture works whenever you do 1031st exchange on a cost segregated asset. It could be long-term or short-term or other businesses too. The same concept applies to hospitals, dental offices, if you're a doctor, warehouses, doesn't really matter. Same concept applies, so understand that. Two more questions I'm going to answer very quick. The second one is, what strategies are available for long-term rental? Say I have a tenant already locked in for the house. What other options do I have for tax savings? I was telling you earlier, Bhagyashri, for you and anyone else, as you dive into real estate, how long-term rental works in conjunction with short-term rental. We got to talk about that. And this is where exactly this passive versus non-passive strategies company comes into play. This is a complicated concept, so I'm going to go into this. But after this call, whoever has attended this, we have 20 people or maybe more. Send them the guide we have on passive versus non-passive, how rich people think and how people are getting started, so they can manage this better. But all I'm saying is this, guys. I'm going to recap this so you guys are on the same page. What are we trying to do? And this will answer the question I was asked about what about long-term rental. The basic concept of real estate is this, and that's what wealthy people do. They have a business income, a real W-2 income, and then they have this real estate. I'm recapping what I said, okay? What they're trying to do is they're trying to take a real estate and they're trying to offset the non-passive W-2 or business income so they can save taxes. How you do that is, like I said, depends on your statuses. Long-term versus short-term, if you qualify as rep status, right? Now, let's say you don't have a short-term rental or you don't qualify as real estate professional. Is a long-term rental still a good tax-saving strategies? And I'll say, this is what you need to understand. I say yes. First thing is, by itself, long-term rental is very tax efficient, meaning you make $100,000 in cash flow, that would still not be taxable though. Meaning, if you're in 37% tax bracket, you do not qualify as a real estate professional, you don't have a short-term rental, but you buy this apartment building, a strip mall, and makes $100,000 cash flow, just by depreciation and cost segregation, even though you might not qualify as reps, you're still saving $37,000 and $100,000. Highest tax savings, right? So very tax efficient income rather than another W-2 or 1099 you're going to do. So if you are in 35% tax bracket, would you rather go make $100,000 of consulting income, which doesn't build your asset long term, or you want to buy a strip mall or in a long-term rental, which can give you $100,000 of taxable income? Which one is more tax efficient? Is the 1099 income, you have to pay self-employment tax, plus you have to pay income tax. That can be almost as high as 50%. So that $100,000 you made from consulting, you pay 50 grand in tax. The $100,000 you made from rental property, you pay zero taxes. So it's already very tax efficient, but can you use the same cost segregation to offset W-2 income? No. However, this is where the Bhagyashri situation comes into play. This is why you should not be signing away from long-term rental Bhagyashri, because as you build your, remember what we just did? We bought this short-term rental asset, $757,000. We just saw that, right? That's the first transaction. You save a lot of money. Hopefully, most real estate investors try to buy properties to make money, not lose money. The good thing about real estate is it has depreciation, which is phantom, so it's not really a loss. That's why we're buying real estate. But starting next year, Bhagyashri, your properties will start making money. What's going to happen is this: the short-term rental, okay, will make, let's say, $200,000 of income, multiple on them. $200,000 in your highest tax bracket. You already did cost segregation. How are you going to manage that income? What you do is, yeah, you can be still buying more short-term rental every year, which offsets your W-2 income. But if you have these two short-term rentals, first year is when you need that material participation. Starting next year, you can completely outsource them, have a property manager take over them. Then you can buy a long-term rental, which is also passive. This is also passive. They can offset each other. So long-term rental, you buy a long-term rental, very cash, or do cost segregation. If you have a short-term rental, they can offset each other now. And you can have another short-term rental, can offset W-2 income. So I know it's a lot of here, there, and all those things. We walk people through this on tax planning calls. This gets complicated. All I'm saying is this: that's called portfolio optimization from tax perspective. Short-term rentals really saves you taxes the first year. Take it, get $157,000. Next year, convert that first year, you try to be non-passive by material participation. Next year, convert it to passive intentionally so that now your long-term rental can save you taxes now, which never saved you taxes before. So someone who asked this question, I know exactly who this asked, and I know we're talking to get you onboarded. Look, I'm telling you this. The long-term rental will not save taxes right now. Doesn't mean that you should not be doing cost segregation too, because if you happen to buy a short-term rental in the next 2 or 3 years, the cost segregated losses from the long-term rental even this year will help you save taxes in the future. You're not losing anything. But if you don't do that this year, you're going to have a lot of complications in the future when you have to file 3115. Ignore all those complications. Let me recap this and then sort it down with the final conclusion is that long-term rental itself is very tax efficient, so you should be buying it and try to save the taxes. So you do cost segregation when you buy a new long-term rental, even though you don't qualify as reps? Yes, because like I said, it's a long-term planning, okay? So I just wanted to say that. I know it's very complicated. We can dive deep into this in other calls. One last question before we talk about LLCs and stuff, because I think we have 10 minutes left, and I do want people to really understand how to structure this to not losing benefit, or even for audit perspective. I'm going to do that next. But one big question that we keep on getting is, for someone like Bhagyashri, how does the legal status and visa status affects the tax savings? Because Bhagyashri is from India. Which part of India are you from, Bhagyashri?
I'm from Maharashtra.
I'm from Nepal, if people didn't know. People who come here in H-1B or in being a spouse or the visa status, you have to remember this. When you live in the US, there's something called substantial participation test. It doesn't really matter your visa status, you are treated as a resident of the United States. To file taxes, you file taxes like a US citizen. Tax saving, you get all the tax savings normally. So that never goes away. But people ask me, how does my H-1B affects my investment, especially short-term rental? Long-term rental doesn't really matter. How does my H-1B status affect my short-term rental real estate tax savings? I'll answer this very quickly. I'm not an attorney to give you immigration advice, but I take it from tax perspective. From tax, there's no visa or anything restriction on an asset. Like I said, you are treated as residents of the United States. So all the tax benefit stays there. What people ask me is, hey, my attorney said I cannot get involved in multiple jobs under my visa. But this is not a job, this is an investment. You bought a property, rental property, and you're managing it yourself. You just happen to have a better tax benefit from managing it yourself versus outsourcing it. That's the only difference. So it should not affect your tax savings. You get same tax savings. There's no restriction. But if you go ask your attorney, since they do not know taxes, they have to be safe. They will say, don't do it. I don't get paid if you don't get your green card later on or citizenship. So I don't want to risk it. That's what they say. But if I were you, I would talk to people who have done it before. Like me, I am an immigrant and I have done this on my own. Some of the properties you're going to buy right now, by the time you have your interview, falls off. You might have sold it, or the tax savings goes away. It doesn't even show in the tax return if you materially participate or not. So again, doesn't really matter, but it's not even relevant when you go for interviews. But talk to your professionals before making decision. CPAs for tax benefit, attorneys for legal advice. But attorneys, I'm telling you, they do not know taxes and they will try to box you up. Don't get boxed up. That's what I'm trying to tell you. So I know it's a lot of things. I'm going to stop now, Kensley, and we're going to go over very quickly on the entity structuring, how you should be structuring entities to make this work, and what you should not be doing is what I'm going to cover next. But I'll stop. I'll let Bhagyashri, if you have any questions, please ask. Kensley, same thing. So we can wrap it up with entity structuring.
Okay. Bhagyashri, I just had a question for you while he's pulling this up. Where are you planning on going with your investing this year and in the future?
Last year we did bonus depreciation for one property. This year we will do for another property, another STR property. We are selling one property to buy a bigger STR, and we will be doing 1031 exchange on this property so that we don't have to pay taxes on when we sell. And what Ashish mentioned, buying a property which is in need of flip, rehab, renovation, so that we can get better depreciations when we rehab that property and also get better appreciation. So that's the strategy we are mainly going into this year.
Perfect.
That's so exciting. And you guys, I will share a QR code for her page again at the end of this. So be sure you're following along because I'm sure she's going to share all of this on her page.
Yep.
I'll tell you one thing, Bhagyashri. So what you're doing is good. Okay, just understand the 1031st exchange and tax implications of that. Run the numbers before so you don't have any surprises. Second thing is, I forgot to say this, qualified improvement property. When you do renovation, I did tell you guys how renovation can really help you with better tax savings, but you do have to meet the requirements though. Qualified improvement property is called qualified improvement. If you improve something, if your improvement can qualify as qualified improvement property, then that's where the tax savings comes into play. If not, there's not going to be any tax savings. There's no QIP for long-term rentals. So we're still talking about short-term rentals right now. Your renovations can qualify as qualified improvement property and get all those tax savings under two circumstances. So understand this. If Bhagyashri goes and buys a short-term rental, a new build, or it was a primary residence before and someone moved out and you want to buy the this property and do a renovation, only do renovation after it's in service. Just don't go buy and do renovation because it will not qualify as qualified improvement property. It lose all the benefit I showed you on the screen earlier. So you should be only doing renovations once the property is in service. But if you happen to buy an existing short-term rental, then that restriction goes away. Let's say you buy a short-term rental from one of the investor, and then right after you buy it, you do a big renovation. It doesn't have to be in the market. It's already a qualified. All the renovations will be qualified improvement property or QIP. But if you have to buy a new build, or hopefully if you buy a new build, you're not doing any renovations. But if you had to add a pool or stuff, I guess pool doesn't qualify as improvement property QIP, but it will get a bonus depreciation. The only complication comes is when you buy a property, if it's not already a short-term rental, list that in Airbnb, have a friends and family book it, take it off, and then do renovation so you're going to get the benefit. A lot of information, but hopefully, some people already going in the journey can benefit from this. Last thing, I have to share this, otherwise all the benefits goes away. Everything we're discussing this, you saw just buying a property and doing renovation doesn't really do anything. You have to meet those requirements. You have to have everything structured correctly. And I want to make sure people are not losing the benefit by doing it in the wrong entity structure because they do that. So let me explain this. I've seen everyone is smart here, right? Bhagyashri, I know she gets approached for this consulting. Hey, can you help me with a short-term rental? And can you advise me? All those things. Let's say she says, okay, yes, I want to do which you should. And she establishes this. She acts as a contractor, like in a consultant, as an STR consultant, and help other people build and manage the property and design even things like that. Once she does that, what's going to happen is she's going to have a S corporation because that's the best way to save non-passive income, like 1099 gigs, any restaurant, Amazon, any kind of service-based business, a gas station, whatever you open, you're going to get an S corporation. That's exactly what Bhagyashri is going to do for her consulting gig in the future. Once she has that, what she's going to do is if she buys any long-term rental or short-term rental, she wants to use the same entity because it only has a bank account, it has only has CPAs, it only has attorneys. She wants to use the same entity to do everything, which is not a good idea. This is why I'm going to show this very quick, okay? It looks complicated. Let's focus on this bottom portion here. Do you see it says rental, real estate, non-rental? Non-rental means anything, could be real estate, but real estate agent, wholesaling, flipping, any kind of, if you're a doctor, if you're a consultant, if you have Amazon store, anything is going to fall in this bucket. The S corporation will save you taxes. Any kind of rental real estate never gets in this bucket. Should never be owned by S corporation. It should always be in another bucket or in your personal name. Because if you have been lied to, let me clarify, this is the only thing you need to understand. The legal structure, LLC, do not save you taxes in the rental world. It's for legal protection and organizing stuff. S-Corp will save you taxes for service-based income, consulting income. And then we can walk you through how to optimize that is exactly where we have a lot of things we talk about during our analysis, corporate analysis. But right now, just focus on one thing. Never buy real estate under an S corporation is what you should take away. How to structure this really depends on your portfolio, your jobs, your trust, and your holding company, which we walk through on our calls. But big mistake people do is try to use a S corporation to do this real estate, either long-term, short-term, or even K1s they get from investing in the deals. Do not do that. That's the only thing I want to end this webinar because we're almost at the time. Well, I'm so sorry, guys. And it's a lot of information, but it's very inspiring to actually see what she have achieved. And she's only going to go do better things, but having a good foundation is going to be great. Bhagyashri, thank you so much for joining. Tell me if you have any parting advice for us and everyone who's listening. Do you want to say anything, Bhagyashri?
I don't have anything to share, but thank you for inviting me. I had a really great time and you had really great insights. Some things I didn't know I learned from this session. So thanks a lot.
Absolutely. And we're always available in email away. Can simply share our screen or QR or whatever you have to share on the screen. So then they know where to find us and find Bhagyashri. and then we'll help you guys out.
Bhagyashri, we might have to have you back on so we can hear how your next adventures go.
Yeah.
But I'm just sharing her information again. You can get in contact with her, join her community. It sounds like she's going to be consulting a little bit more with short-term rental and long-term rental investors. So if you guys have any questions for her, feel free to reach out, and then we'll send all of this in an email too. I know I went quick with that, but we'll send all of this in an email after this. Thanks again for joining us. Be on the lookout for that email, and we will see you guys next time.